The balance sheet. The balance sheet is one of three key financial documents that you'll use to analyze companies. And it's equally important to the cash flow sheet and the income statement. So balance sheet, cash flow, income statement. You'll hear people talk about those three all the time. The balance sheet it shows assets, liabilities, and shareholders' equity. And it's important to understand that the balance sheet, as opposed to the income statement, is taken at a point in time. Think of it like a photograph of a financial point in time for a company. So it just shows you what they own and what they owe at one point in time. As opposed to an income statement, which is an analysis of the operations, the revenue and the expenses over a period of time. You know, the income statement may say, we did this much revenue in the first quarter. The balance sheet says, at the end of the first quarter, here's what we owned, our assets, and here's what we owed, our liabilities. Okay? So balance sheet, income, cash flow, three documents you're going to learn and use a lot. Really what the balance sheet does is it tracks the net worth of the company. It shows you, what's the whole thing worth, essentially. And we'll look at an example in a second, but the key mathematical equation to understand is assets equal liabilities plus shareholders' equity. Assets, what are they? It's the stuff you own, essentially. It's anything worth money or of value inside the company. Liabilities. Liabilities are things like money that you owe. Liabilities are costs and things associated with running the business. And then shareholders' equity is the value that the shareholders hold inside the company. So assets are often split into current and non-current. Current assets are easy to turn into cash, or they are cash. It's things that within a year you can make turn into cash. They have some liquidity. Non-current or long-term assets would take greater than a year to turn into cash. You can figure something like a building might be a long-term, whereas cash or receivables, accounts receivable, might be a current asset. We'll talk about those in a second. I'll give you some examples. So liabilities, there's short-term and long-term liabilities. Short-term are the ones that come due this year if you've got some loan that's maturing, or you have accounts payables, anything that's got less than a year until it comes due. And then long-term would be like a long-term loan, like a bond that if you borrowed money by issuing paper, or a loan with a longer term until it's due. So shareholders' equity includes any money invested into the business and retained earnings, meaning if you had earnings left over from last year on your income statement and you decided to keep those in the business, that becomes shareholders' equity. It's retained earnings. You can use those to do things, and any investment that you made, if you sold stock, any of that money coming in is also shareholders' equity. So there's two different kinds of ratios that the balance sheet will generate and that people will use to analyze balance sheets, and that's somewhat important to understand as well. The first are financial strength ratios, and the second are activity ratios. I misspelled ratio here, but financial strength ratios include things like working capital and debt to equity. Those are leverage based. They show you how much leverage the company has, meaning have they borrowed any money, and what sort of long-term financial health. If you've got tons and tons of debt and no cash, maybe that's going to raise some eyebrows or cause some concern. And then activity ratios are things like that deal with receivables and inventory and payables. Those tend to analyze one operating cycle. So activity ratios tell you how good is the company at doing its thing this year. And the financial strength ratios will say, well, how much money have they borrowed in general, essentially, if any. So keep that stuff in mind as we talk about this balance sheet example. So let's look at Hasselhoff Motor Company. We're just looking at 1 year here, sorry. So Hasselhoff Motor Company sells red convertibles with David Hasselhoff's image on the side. So if we're going to take a look at the balance sheet here, and remember, this is a photograph, it's a point in time of the financial health of the company. It's what they own and what they owe. So we're just looking at right now what's going on with Hasselhoff Motors if I'm an investor. So here's what they own. Here are assets, and these are current assets. And if you remember current assets, we said easy to turn into cash in a year. So we've got cash, first of all. He's got $5.2 million in cash. These are in the thousands. He's got receivables, meaning people owe him money. He's got some customers that haven't paid for their cars yet. He's got $3.1 million in receivables, and he's got inventories. He's got $33 million worth of cars sitting on his lot. Those are all things that you could quickly turn into cash, so those are current assets. And that's $41 million in current assets. And then we're going to look at his property and equipment. Now these are longer term assets. These are it would take more than a year to turn them into cash. So he's got land worth $15 million that his dealership sits on. He's got the dealership itself and some other buildings that are $55 million. He's got fixtures and things on his properties that are $21 million. And then he's got some equipment around, pickup trucks and other things that are $2.1 million. So his property and equipment total is $94 million. Now we take depreciation out of the property and equipment of $19 million, and so his net property and equipment at cost is $75, and that's going to be important because we're going to use that to figure out total assets. So he's got about $75 million in total assets, and then he's got $11 million in goodwill. And goodwill, really quickly, is just a non-tangible asset that represents value, like of the brand. So Hasselhoff Motors might be pretty valuable and interesting because it's associated with David Hasselhoff. So he's got $11.7 million worth of goodwill. So if you add up his total current assets, his net long-term property and equipment, and his goodwill, you get $128 million in assets that he has to deal with. So that's what he owns. Now what does he owe? So if you look at liabilities and shareholder equity on the other side, these two, this is why it's called a balance sheet. This piece, assets, has to equal liabilities and shareholders equity. There's a balance there. You'll notice the numbers, the total numbers are the same. So let's look at what he owes. Well, he issued some bonds and borrowed $4.2 million, so he still has to pay that out. He's got accounts payable. He's got to pay the producers of the cars and a whole bunch of his employees and all that. I'm sorry, his vendors and all that. So he's got $24.1 million in accounts payables. And then he has some liabilities that he's carried over from last year at $13.2 million. And then he's got some short-term debt. He's got $5 million worth of short-term debt that's going to come due this year. So his current liabilities are $46 million. Then he's got some long-term debt that he's borrowed over a longer period of time of $26 million to finance his purchase of cars and other things. And then he's got deferred income taxes that he didn't pay from last year of $6.1 million because he made some income last year. So how much shareholders' equity is there? He's got no preferred stock. He's got very little bit of common stock. But he's got a bunch of retained earnings from years before he made a bunch of profit. So he's got $49 million in retained earnings. So his total shareholders' equity is a little over $49 million. So if you add up his current liabilities and his shareholders' equity, and then you include his long-term debt and his deferred income taxes, he's at 128. So this balance sheet is in balance. So that's what the balance sheet does. It shows you what you owe and what you own. It shows assets, plant and equipment, short-term assets like cash and receivables. It figures in things like depreciation and intangibles like building a brand. And then on the other side, you're looking at what he owe, bonds, money that he borrowed, accounts payable that he still owes vendors, debt that he's accrued, and then any retained earnings he's brought over from years past. So that's the idea with the balance sheet. It's a snapshot in time. It shows you the relative financial health of a company at that point in time. And you can learn more about these ratios that look at leverage, how much money has he borrowed, and operating cycle challenges, meaning receivables, inventory, payables, how good is he managing that stuff. So that's a balance sheet. Get to know it.